Think we are already live on YouTube. We
All
are
right,
live on YouTube already. All right, buddy, you ready?
let's do it.
So so for the silent auction, you're going to give yeah, we're going to talk about the golf tournament. Okay.
Yeah, it'd be great for you to go to the silent auction too. It's auction.jwbcares.org.
Yeah, we got it in the chat.
Okay, awesome.
Oh, you want me to go to the site?
Yeah, that'd be great as I'm talking about it. And once I kind of go there, I think it's always cool for people to see it.
Easy peasy. I can also go to the Ryan Lee's book.
Yeah, awesome.
Okay. You ready, bud?
Let's do it.
All right. It's from the cars. Look at this technology. Amazing.
How about that?
How about it?
This is so much better than the last time too.
Is it?
Yeah.
Welcome, everybody, to the weekly edition of the Not Your Average Investor Show. Big news last week. Fed finally dropped the funds rate, and we are going to talk about how's this going to affect mortgage rates? How low can they possibly go? What's going on out there? I'm your host, Pablo Gonzalez. With me, joining us through the miracles of technology, fresh off a speaking engagement and in his car, the man that I affectionately like to call GC because he's got the genius concepts, knows how to generate cash flow, is a great co-host, and is called Greg Cohen. Say hello, Greg.
Hello, everybody. I am fired up to be here. We are on the move, but we are here for the show today. So great to be here.
Do not let anybody tell you that GC won't move mountains just to be on this show on a weekly basis, my friend. I think it's amazing. I think this is the second time. Where are you coming from, GC? Just give people a little bit of context.
Yeah, there's a real estate investor group here, and they meet up at a restaurant here, and it happens to be about an hour from the office. And so they asked me to come and to give the Q4 real estate market outlook. So I did, and I originally thought the meeting started at 11 o'clock in the morning. And then I came to find out that it started at 11:30, and there's like 10, 15 minutes of announcements and whatnot. So we did, the hour-long Q4 market outlook in about 15 minutes, and had room for one or two questions, and then booked it. So we're here, baby.
The market wants the market outlook from JWB, put together by Greg Cohen. You got to give it to the people. You know what else we give to the people when we start the show, GC?
What's that, baby?
The Rogal baby. We start off with our leadoff batter. Get batting first today, John Henning. We got the Shaw man in the house, Nadeem Shah from the Pacific Northwest. We got Il Maestro, John Williams, world famous composer from Long Island, New York. We got the Ringmaster, Drew Barnhill. We got Laura Colby from Washington State. Hope you're doing well too. Deborah Seminario from Santa Fe, New Mexico. Deborah, I think that's a new name.
New name.
New name. Deborah, welcome to the show. Greg's not usually in his car. He's usually in the studio here with me. So don't get used to those beautiful aesthetics over there. We got LinkedIn Lowry in the house. Ed Lowry checking in with a good afternoon. We got KOB, King of the Beach, Christopher Lee from Fernandina Beach checking in. Who else? We got the Maven from the mountains of Denver, Leslie Wilson. Love to have you here, Leslie. We got our regulars, Gary and Rosalind Riley from Murrieta, California. Ooh, we regard you. Who else we got in here? Belinda Baldwin from Dallas, Texas. That's a new name.
New name.
Welcome to the show, Belinda. Make yourself comfortable. Make a friend. We got the first family in the house, the patriarch and matriarch, Ken and Carolyn Moline. We salute you. We got Eric Brown from Aldi, Virginia. I feel like we got a bunch of new names today.
I do too.
Eric,
that's awesome. Welcome.
Eric, good to have you here. Who else we got in here? Ehab Eskander from Canada. Good to have you, Ehab. Another new name, I believe. Dejavir Speller as well from Indianapolis. Good stuff.
Indianapolis. That's my buddy. That's Dehav. That's my buddy right there.
Dehav.
We've known each other for 20 plus years. That's right. And he's a JWB client.
Yeah. I bet 20 years ago, did you call this unprecedented Indianapolis Colts run that they're on right now?
We probably talked some trash back 20 years ago, he and I.
Probably. All right. It is happy to be here with everybody because today we got some breaking news. GC, what do we got about the silent raffle? Tell us about the golf tournament yesterday.
Yeah,
JWB cares. Tell me what's going on.
I've had this smile on my face for 24 hours, man. Yesterday is hands down the best day of the year for JWB. We had our charity golf tournament. This is the 8th year that we have come together as a community and held our charity golf tournament. And, It's not, of course, just about the golf. It's about being with everybody, but it's about a whole lot more than that too. Through JWB Cares and through all of your generous donations and our entire community's generous donations, we raised $160,000 this year. And that golf tournament is a celebration day of all of the hard work for raising all of that money. And guess what, guys? That $160,000 goes to being a part of the solution of the affordable housing problem. And what we know is that the best way for regular, everyday people to become financially secure and eventually financially free is by owning a home. And for especially renters, it has become very, very hard and many obstacles to do that. But through your donations and through JWB Cares, we raised this $160,000 and we went to our residents, our community of renters, and over 450 applied to be able to receive a grant for their down payment assistance, and 8 lucky JWB residents earned their grant. And so that means that $160,000 is now 8 $20,000 down payment assistance grants. And we will have 8 new first-time homebuyers here in Jacksonville. So I first just wanted to say thank you so much. So many of you just donated when Pablo and I asked for you to open up your wallets to donate. And on one show, we raised over $2,700 just from all of you. And that just meant the world to us. So thank you, thank you, thank you. I hope you feel the impact that you're having, because it's not just these 8 families. Think about the dozens of people and their family and in their neighborhood who then become affected by this positivity, right? And now pretty soon we have hundreds and thousands of people who are affected positively by home ownership. And so that's what you're a part of. Want to say thank you. It was just an incredible day yesterday. And we also used that day yesterday to do other things to raise money for next year. And one of those activities is our silent auction. And so I also wanted to ask you if you would love to be an even bigger part of this, or if you missed out on the opportunity to give last year, the silent auction would be a great way to do that. And Pablo, thank you for bringing that up. We do the silent auction and it helps support our mission here. You can bid on items, and I took note of a few of them there. Look at that, a night at the Sphere in Las Vegas.
I saw this. I want it.
I know, right? I know. We've got a Disney World golf package, Kentucky Derby experience, Porsche Sports Cup race weekend. I mean, there is a ton of really, really great stuff to bid on. And you all know silent auctions are a great way to get a really good deal on some of this stuff. And there are also more local things to do as well, like Topgolf and other things. So please, if you would love to be a part of this, we would love for you to be able to enjoy this special moment as we prepare for next year, and would love for you to go and donate. You can go to auction.jwbcares.org. And the silent auction is open now. I don't know when it shuts down. I forgot to put my notes together, but please go there, see if you can find something you'd love to bid on and support the efforts here.
I love it, GC. I love a good deal.
Yeah, it's right, man. There's a lot of good ones out there, man. Go check it out.
I see some stuff I like. I've been dying to go to the Sphere. I love Porsches. So I'm going to take a look at this thing myself. That's for everybody that is listening on audio. Isn't in the chat. Joanna put the link so you can just click right on it, but it's auction.jwbcares.org. GC, I don't know if I'm allowed to share this, but you shared with me a video of compilation of these residents receiving their grants. And have you shared that yet at large?
No, we haven't shared it yet. It's coming.
I just want to tease one thing. There is one resident that says, living in a JWB property was a strategic move by me because I did not see a better way for me to be able to cross this path from renter to homeowner. That just gives me goosebumps repeating it. The fact that that's out there in the ecosystem, that because you rent somewhere, you believe you can become a homeowner, you can believe that you can cross this like intergenerational wealth kind of like bridge into building real assets for your family forevermore, is something that stays with me. And I still think about that, the 3 seconds of that clip, man. Really incredible that you guys have continued to do this. Like this golf tournament's been around as long as I've been seeing it, and you guys keep doing more and more, from like 1 house to 2 houses to 3 houses to now like helping 8 different homeowners. Really, really cool, man.
Man, been doing this for 20 years. And I got goosebumps when I watched that video. And in the TMM today, in our team meeting today, our team got up and shared what it was like to go and actually deliver that news and the $20,000 check, the big check that people got to hold, and getting to give those folks a hug. They invited them in to sit down on the couch and just to like talk about their stories, man. Goosebumps, not a dry eye. And so I'm excited to share more and more of those videos with you as we button those up and get those ready for everybody.
I will. I promise to share it in the WhatsApp community first for those of you in there. And in another little bit of breaking news, GC, what's going on with this? Your buddy wrote a book. Ryan Lee wrote a book, and you're going to be part of an event. What's going on here?
Yeah, this is a good friend of mine that I've built up a really strong relationship with. I've learned a ton about his thoughts. I think he's one of the foremost financial strategists, beyond rental property investing. But guess what? He loves rental property investing as well. And so he just put on an event. He asked me to speak at the event, so I get to share the stage with some of my idols who got me involved in this beautiful asset class, like Robert Kiyosaki. You can see here he wrote the foreword for him, and Robert Allen. I mean, some really heavy hitters. So super thankful that my friend, who is Ryan Lee, is putting this event on and has me, sharing the stage with some of my idols in the space. But Ryan also wrote this book. And I read a lot of books, and I don't always bring them to you guys. But here's a book that I want everybody to read. I just bought my own copy. I know everything that Ryan shares in this book because he presented this to my team, and it was one of hands down the best presentations to understand beyond just rental property investing and a model that delivers passive income. But the punchline here is that rental properties are the perfect asset. And it's all about retiring in 10 years or less, unlock your passive income machine, and secure your tax-free income for life. The tax-free income for life component is something that you've probably never heard before. So I wanted to encourage all of you to go and buy Ryan's book. There we go. We just put the link up there. Ryan's a good friend, but I don't get paid to promote this. So I just think it's a great book. I went and bought my own copy, and I would highly encourage you all to do the same. Ryan Lee, you can just find it on Amazon.
I'm literally just buying it right now as we were talking, GC, but that just makes me more distracted. I got to host a show. Very cool, man. I like the idea of you sharing books that you're reading with our community, man. It might seed, who knows, Not Your Average Investor Book Club. We can kind of like keep up with it in the WhatsApp chat. I think it'd be
I love that.
Interesting thing if we only had like a maven or a fairy godmother or an MVP in the community that wanted to lead up this or a ringmaster. I don't know, like we just if somebody wanted to lead up like a book club about this, I think it'd be really 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 interesting.
I love it.
Awesome, man.
Might be Laura Colby. She gave me a very special book that I'm reading as well. So maybe shout out to Laura Colby for sure. But I think a book club would be awesome.
Yeah, book club would be cool. And I feel like you just kind of glossed over this idea that you shared the stage with Robert Kiyosaki in an event coming up.
It's cool, huh?
Yeah, man. That's crazy.
Yeah, I'm really thankful. I'm getting a little sentimental now because we're going to be celebrating our 20-year anniversary as a company in January. So, be prepared to see me hold back a few tears, or probably not even hold them back in the coming months. But yeah, this is a nice moment just to think about the emotions that I felt when I first read that book, and now to be sharing the stage and to be, espousing those same concepts and helping others through this show and through, our clients. It's a special gift. So very thankful to Ryan and his organization.
Amazing, man. Very, very cool. Very cool. All right, so let's get to the news of the day, GC. The Fed, long awaited, right? And by long awaited, I mean like what, 2-3 years awaited?
Yeah.
Finally cut the Fed's fund rate by 25 basis points. For those of you like myself who don't really know what basis points are, it basically means 0.25%, right? They cut the Fed funds rate 0.25% down to 4% from 4.25. They're projecting 2 more rate cuts this year, which, means more of this stuff happening ahead. And as we all know, this is big news for real estate investing. If you listen to the quarterly market update, quarterly market forecast last week, one of the reasons why the why the market has slowed down has been rates higher than normal, longer than normal. So this represents a big shift in a trend that started 2 years ago, a little bit over 2 years ago, and now it's starting to come down. GC, what is your first kind of reaction to this news?
Well, I'm just going to speak squarely from the lens of rental property investors. This is great news. This is a great thing. Because as interest rates come down, it immediately boosts our cash flows. It immediately boosts our return on investment. So if I'm squarely looking from the rental property investing lens, this is a huge win, something that we've been waiting for a long time, and something that I'm excited to talk a little bit more about, like why it's happening, so that not only do we know that it's a great thing today, but what can we expect going forward in the future? And then I'll just kind of expand a little bit beyond rental property investing lens. I mean, it's not just rental property investors that have been really, call it, I don't know what the right verb is, but we all have been waiting for interest rates to come down a little bit. Businesses, consumers, investors, everybody. When interest rates went up as high as they have and they stayed elevated, as I shared in the quarterly market outlook, that has never happened in recorded history. What we have endured from an interest rate perspective, and the cost of things just to conduct normal daily lives have gone up so much in the last few years that hopefully not just this quarter point reduction to the Fed funds rate, but hopefully this is signaling that we will see lower interest rates for the Fed funds rate, as well as our 30-year mortgages in the coming months and year.
Yeah, man. It's been this really tricky conversation, right? Like the Fed has, their mandate is to curb inflation and to keep, employment high, right? So they have this double mandate. Their tool is essentially this interest rate thing. And as inflation went rampant before, right? Like they started raising rates. It feels like inflation has been down for a while. But yet they haven't been, they've been kind of like looking for not to like restart it again, also looking for a little bit higher unemployment to happen. So to make sure that they're not like putting an ember on a, like fanning like a fresh ember that could start the fire of inflation again. It's been up and down. There's been a whole bunch of political drama. It finally happens now. And what we are seeing, at least by the numbers I looked up today on perplexity.ai, saying rates are around 6.4%. You said that that's not surprising to you. You wouldn't be surprised if they were anywhere between like 6.3 to 6.4. What have you heard about rates from your side?
What do you mean as far as like what rates are today, or where do we see rates going?
Um, I feel like you have been talking about the fact that rates had already gone down and you weren't
Yeah.
sure if they'd go down further. So I kind of wanted you to like dive into whether or not that happened and give us a little background there.
Yeah, absolutely. So it's not just as simple of a story as like the Fed decided to cut rates, interest rates are down. For any of us data nerds out here who actually track interest rate movement on a daily basis, it's really interesting to use this as a case study, because what actually happened is rates started to have a massive decline in relative standards, meaning rates went down almost a third of a point, which is a lot of movement in really about a week to 2 week span. But it was way before the Fed actually cut rates. And this is what happened. So there's a big difference between when the Fed signals something or when economic reports come out that signal something, versus when the Fed actually makes the cut. And if you wanted to be ahead of the game and actually get the lowest interest rates possible, you would have needed to pay attention to the Fed. You would have needed to pay attention to those economic reports. Or more importantly, you would have needed to talk to a team of experts like our team, or be a part of this show, who could analyze and say, you know what, the movement in the mortgage market actually happened a few weeks ago. It dropped to a very low level. And then when the Fed funds rate actually dropped that quarter point, you know what happened, Pablo? Interest rates, the 30-year mortgage interest rates actually went up right afterwards. So all in all, rates are down, which is wonderful. And that's the punchline here. But there's also another punchline that, like, if you are waiting for the headlines or when the Fed actually made the move, you're missing out on the biggest opportunity. And that's really, I think, the value of a community and the value of surrounding yourself with experts as you are making financial decisions.
It's interesting, man. I don't know how many times you've lived this of, you know, rates going up and down like this, but I never thought that I'm used to seeing this from the stock market, right? Like I'm not comparing assets, I'm not doing anything like that, right? But like like it's often confusing for me to see like Nvidia reports world-shattering earnings and their stock goes down. Right.
Yeah, right.
Because it was already priced in or people already thought it was coming, like these kinds of things like that seem like good news, but then report otherwise. Sounds like mortgage rates kind of like vary on a similar kind of marketplace where perception is reality and supply and demand is in real time. Like how often does that happen? How often do mortgage rates move, and like how often do they move significantly? I'll just kind of like stop there since you said that you
Yeah.
track it every day.
Well, that's a great question. So how often do mortgage rates move before the Fed actually takes action? All the time, all the time. So it's based on, and this is how, and we can get into like how mortgage rates actually work, but it's more important to follow what the signal is, and the signal can come from the Fed or it can come from economic reports, and really it's a combination of both. What does that signal mean, and what does that do to investors? Where do investors start to move their money? And then ultimately, that is what affects our 30-year mortgage rates. So, like the fact that the Fed actually dropped the Fed funds rate a quarter point is like it's the I don't know what you call it. It's like the end of the chapter. It's the last page of the book, when you really have the opportunity to read from the first page of the book. And if you really want to be able to use this information to your advantage, you have to be a part of shows like this so I can help bring this to you. We actually talked about this many times as it was happening a few weeks ago. So that's very normal for mortgage interest rates to move in that direction before the Fed actually makes their cut. Now, I'll bring up a little bit of a difference, though. I think your point of like Nvidia reports and how the stock market works, there's a big difference there. So, and in that example of a certain company's valuation or their stock price going up or down based on reports, it's all about what was the expectation for their numbers and did they hit it up or down. And you can't have insider trading in the stock market, so you don't have access to what the report was going to say before the report hit. So it's just about, was it above or below expectations? And even though a company could have made a lot of money, if it wasn't enough as far as what they were expecting, then their stock price may go down. In real estate, insider information is allowed. It is encouraged, right? You are allowed to understand what is going on. You're allowed to understand the signal because the Fed makes statements or, economic reports are released. That is the signal. And well-trained eyes who have data experience in doing this can put the building blocks together for the argument of what, how you can benefit from this as an investor. So it's one of the reasons I love real estate. You can look at all these data points, you get access to the report before mainstream hits it, and then you of course can make better decisions because of it.
I love it. I love talking about how insider trading is actually not a bad thing in real estate, right? Like the idea, like the data is always out there. Real estate is much more like you say, like you have the answers to the exam before they give you the test, and it's not really hard to understand that piece. That being said, GC, I like to come up with these analogies of like, and when you're talking about kind of like a signal versus close of the book, I see it kind of like you might be driving around, it might be raining, and you'll see a lightning flash in the background. You only know it happens if you're looking for it. But then when the thunder hits, everybody hears it, right?
Right.
So
Yeah.
maybe the signal is the lightning, and then the actual movement of the Fed or the movement of the rate is the thunder that everybody feels, and it reverberates around everything. But keeping an eye out on these kinds of things, you get to see the lightning before the actual sound of the thunder hits. Lee says it's a great analogy, so I'll take it.
I
He's the
like it.
MVP. GC, why don't you explain to us how mortgage rates actually, like how they are valued, like what is that lightning that we're looking for before the thunder hits? I know it has to do with the 10-year Treasury yield. I just have
Mhm.
no idea what that is or how to talk about it.
Yeah, absolutely. So it all comes down into movements of money. Our long-term interest rates are a factor of movements of money. And so what we all need to think about is that on the other end of us paying our mortgage, our interest rate, there's another investor on the other side who says, hey, that's a really good deal for me. And that investor has other options of where to invest. They just decided to invest in holding your mortgage. It's called a mortgage-backed security. So investors are always deciding, do I want to put my money into mortgage-backed securities, or do I want to put my money into similar assets? And the most similar investment opportunity that somebody would have, other than a mortgage-backed security, would be a 10-year treasury. That is a bond. That is a debt instrument with the government. And it's a 10-year horizon with the government. Obviously, it's basically risk-free because the government can basically print our own money. So people look at that and they say, well, that's a risk-free investment that has a 10-year horizon. And then when you look at home ownership, people generally stay in their homes between 7 to 10 years. And so those are those long-term investments that people are making. And what the market has shown is over time, what we see is that there's about a 1.7% premium that an investor will require to be able to put money in mortgage-backed securities versus 10-year treasuries. So it's comparing like assets. So if we want to think about what really drives our 30-year mortgages, yeah, it is related to the Fed indirectly and what the Fed does when it drops this quarter point. But the vast majority of the effect is what is going on with 10-year treasuries. And as we look at what the yield is on a 10-year treasury, and we look at what the interest rate is for us as investors, as our 30-year mortgage rates, you'll see that generally speaking, there's a premium there. Today, the premium is a lot higher than historically what it has been. So the premium is about 2.3%. So bonds are at about, I'm just going to make it easy, right? Bonds are at about a 4% yield. Our interest rates are at about a 6.3. Our interest rates are at about a 6.3% mortgage. That spread of 2.3% is the premium that investors are saying, hey, you know what? I need that for it to be a good deal for me to invest in mortgage-backed securities versus putting it into bonds. Does that make sense?
Yeah, that makes sense. It's kind of it's basically it's all relative value is what I'm hearing essentially, right? So like 10-year yield, you have a certain value, you have a certain risk profile. It's basically like the lowest risk profile possible. You're willing to take a little bit of extra risk for a little bit of extra cash, right? Like a little bit of extra return, kind of thing between the two of them. It makes me think that what are the things that if the 10-year treasury is the lowest risk profile possible, what is the risk to the 10-year treasury? Is that why is it essentially basically betting on inflation, if inflation is going to happen, or like I would assume that it's just kind of like what that money's going to be worth tomorrow versus like betting on a hard asset that goes up with inflation and stuff like that. Is that where the spread comes from?
Yeah, inflation's a big part of it. There's a lot that goes into why people choose to put their money into 10-year treasuries. But if we're going to simplify it for this conversation, a big part of it is questions about inflation. And like, think about it. So if you're buying a 10-year treasury, like let's say you're putting $1,000 into 10-year treasuries and you're getting a 4% interest rate. If you think that in the future that treasury yield, that 4% is going to go down and you still want to be in treasuries, what are you going to do today? Are you going to put more money into treasuries today at 4%?
No.
Yeah, you would.
You would, but is it going to go down?
Well, yeah. So this is the yield we're talking about,
Oh, okay.
not the price.
Okay.
Yeah. So like, think about it. So like, all right, you have the opportunity to earn 4% on your money today, but you think based on what's going to happen in the marketplace that tomorrow you're only going to be able to earn 3.5%, right? If you are making decisions with your money, or if you're controlling large swaths of money, and this is really how it's done with big pensions and pension funds and large amounts of money, they say to themselves, hey, well, if I think that the yield on the 10-year treasury is going to go down today, well, I'm going to I'm going to get in before it goes down. So I'm going to buy a bunch of those 10-year treasuries. And when there's more demand for 10-year treasuries, the price goes up and the yield goes down. And then when that happens, the yield has gone down. That same kind of spread is in place versus our 30-year mortgages, but ultimately our 30-year mortgage rates go down. So even more than just needing the Fed to drop it a quarter point, meaning the Fed funds rate a quarter point or whatnot, what we all as rental property investors should be really rooting for is that people want to buy 10-year treasuries, because if there's a lot of demand for 10-year treasuries, then the yield of 10-year treasuries comes down, and then our yield for our interest rate for our 30-year mortgages comes down by a similar margin.
Got it. Got it. Lee said I had a 50 chance of getting that guess right. So yeah, I just threw it out there, man. I got confused by the wording. I thought it was going down, so I didn't want to get more, but yeah, now I get it. If I know that I'm going to get a better deal today than tomorrow, then I'm pushing my money into today versus tomorrow is essentially what happens with the 10-year treasury.
I did probably the worst thing, like if you're like trying to prove a point financially and somebody has no clue of the numbers that are in your head and just put them on the spot in front of hundreds and maybe thousands of people. That was my bad, dude. That was my bad. So
I appreciate it. Listen, I think it makes the show better because then you have to explain it better. So I'm doing my job by being the noble fool out here. That being said, so that is kind of like what can make mortgage rates continue to go down is if this idea that we think that the treasury yield is going to go down. Let's just talk about the snapshot today, GC. Based on this movement, based on what's happening, what does that look like today for rental property investors? What has changed?
Well, so I want to add one more component to it because I think it will be relevant to your next question here. So inflation is ultimately what is driving those yields of the 10-year treasury. And so what we've seen recently is we've seen job weakness, we've seen weakness in the labor market. And so what that has signaled to everybody, including the Fed, is that we think that we are going to see lower inflation numbers, because if there's high unemployment or higher unemployment, that would lead to potentially lower inflation numbers. And so us as an economy and those who manage money thinking that lower inflation may be happening because of the weakness in the job market is leading people, or led people 3-4 weeks ago who control a lot of bond money, to say, hey, you know what? If we see inflation becoming less of a concern, well, then the yield on 10-year treasuries is probably going to go down. So then they said, I want to lock in my investors' money at 4% or whatever it was, 4.5% a while ago. And then as that happened and that groupthink happens, then we saw more of a decline to those 30-year mortgage rates and also those 10-year treasuries. So it's really about, what do we think about inflation? So to relate it to your point here of, hey, what does this mean for rental property investors? Guys, we already know that this asset class performs in good times. We also need to remind ourselves that this is the right asset class to be in confusing times economically, or even potentially bad times economically. And that's why I love building my retirement account off of this asset. It's because if you see negative economic news, what tends to happen is that people rush to bonds, meaning they buy bonds. And then when that happens, the yield on the 10-year bond goes down. And then when that happens, your interest rates on your 30-year mortgages tend to come down. And then when that happens, it tends to spur housing demand, and more home sales happen, and higher home price appreciation happens. And so there are so many ways to win in this asset class. We don't have to know what's coming next year. But most of the time, if you run these scenarios of what if this happens, it ends with, even negative news ends with lower interest rates, and that spurs higher housing demand. So what does this mean for us? This is great news to see our 30-year mortgage rates come down. Specifically today, we're seeing more cash flow on our properties than we have in our recent history. And that is a wonderful news. Now, is the cash flow going to change your life? Is it $500 a month? No, because that's never been the most important reason to buy rental properties. But if we can squeeze out an extra $100 a month here or there, well, that's a wonderful thing, right? It increases our return on investment, but cash flow is a peace of mind metric as well. So a wonderful thing for us here today, and it still reinforces the positive news of growth long term, because anytime you're seeing the case to be made for lower interest rates in your head, you should start to think about more mortgage applications coming, more home sales coming, and then more home price appreciation coming. And you're in the right market if you're invested in a growth market like Jacksonville. So no change to the long-term trend line. And we know that this asset works long-term, but in the short run, it just gets a little bit easier to, for investors to convince themselves this is the right move, largely because of lower interest rates and cash flow.
Got it. So slightly lower interest rates, slightly higher cash flow. Right now, based on the scenario, you can get more home for your money if you are a retail buyer as well. More likely to move houses, upgrade houses if you need to, if you've had a life-changing event, because it's easier to have like a lower monthly mortgage payment. Therefore should accelerate the sale of homes, I would imagine, right? Like this idea of kind of like we've had higher than usual inventory for a long time. This should start maybe, denting into that inventory. Is that also something that we should foresee?
I wouldn't go that far right now. What I'm trying to share is the concept here. Now, the actual play-by-play of how this works, we don't know enough right now. Ultimately where we landed, we had about a quarter point drop to our average interest rates on our 30-year mortgages from all of the news that happened. Is a quarter point going to be the thing that's going to drive people to start applying for mortgages and then buying homes? I tend to think not. I think hopefully this is the beginning of more. But yeah, I think you're going to start to see some things tick up. I know you were looking up mortgage interest rate applications going up, right?
Yes. Refinance application volume has surged 60% in the last week compared to the previous week.
And refinances are the first thing to surge because it's an easy equation for folks, right? If I can drop my monthly payment, or if I can drop my monthly payment and pull cash out, that's an easy thing. So you tend to see that first. What we really, and that's not a sale, right? That wouldn't show up in home sales data going up. That really wouldn't show up in housing pricing going up because of it. You probably need more drops of interest rates. I'm hearing somewhere around crossing that 6% average interest rate plateau is when we tend to think, and a lot of people I respect in this industry tend to think that would really open the floodgates for for home sales to really to really jump up, and of course home price appreciation would follow. So I would say you're going to see a lot of mortgage applications. The refinance side makes a ton of sense for JWB clients. This was a great time to talk to your portfolio manager. As we've mentioned, we have hundreds of millions of dollars in our client base of equity that is just sitting there waiting to be tapped. And if you tap that equity responsibly, then what you can do is you can speed up your accomplishment of your financial goals without bringing any money out of pocket. So I think that is a big opportunity. And I think that we will see how this plays out as far as how much of a spike to home sales and home price appreciation really over the next, I would say, year.
Got it. So about a year until we get some like real clarity around home price appreciation. But right now we're seeing what we've been talking about for a while, this idea that you date the rate and marry the asset, right? Like folks that have bought in the past with higher interest are already refinancing, already lowering their monthly payments. They're able to use that money, whether if you're a homeowner to improve the home, or any other kind of like investment that they want, or if you are a rental property investor, acquire more properties, do stuff like that. That's already happening, at least in the week-to-week figures, right? Like that's all I pulled up, right? Like 60% of people refinanced. All right, man. Well, I feel like there's a couple notes that you sent me of things that most people don't understand, kind of like nerdy stuff that I know you'd like to get into. One of the things we danced around was this idea of like, inflation expectations and risk premium. So like one of the things that could happen is if we believe that inflation will continue to go up, then people will continue to demand higher yields from the treasury from these treasury notes. Can you explain that?
Yeah, I mean, if we're going to keep it in the simplest terms, inflation going up is a bad thing for interest rates for our 30-year mortgage rates. And it's if we want home price appreciation to happen in a large amount next year, inflation is our enemy, really. So when inflation happens, the Fed tends to have more of a tightening policy. So the Fed typically would not drop the Fed funds rate. As we mentioned, that is not directly affecting our mortgage rates, but that is a huge signal to investors who control large amounts of money. And so when there's high inflation, when inflation and concerns of inflation are high, then ultimately that means that our long-term interest rates are probably not likely to go down. What we have seen recently is the opposite. And so when we see the Fed actually signaling and then dropping the quarter point, that's the Fed saying, hey, you know what? I'm a little concerned about not inflation. I'm concerned about jobs. I'm concerned about a recession. And so when the Fed signals that and the economic reports signal that, well, now recession is another way of, deflation. It's not exactly deflation, but you're certainly not concerned about inflation most of the time in a recession. So now the focus shifts to like, how do we make sure that unemployment stays low? So we hit that mandate. And when that happens, that tends to see lower mortgage rates for us as investors. And, that's why I keep saying this asset class performs really great in great times. We saw that when, the economy has been roaring and home values have gone up, probably 50% in the last, 5-8 years, So we have seen that it performs really well in great times. But I think what a lot of people miss is that this asset performs so well in tough economic times. And a lot of that is understanding that when you have tough economic times, largely there's labor weakness. And a lot of times that leads to dropping our mortgage rates indirectly. And then what does that do? That tends to heat up the housing market. So that's why most people don't understand this, but there's a myth when it comes to recessions. People think that housing goes down, home values go down in recessions. It just doesn't happen that way. 5 of the last 6 recessions, home values went up. The only one that it did not was an anomaly, which was the Great Recession. But if we can take some time to understand what we've just been talking about here, and you understand that when there's labor weakness or there's problems in the economy, the first thing that the Fed does is it typically drops the Fed funds rate. That signals to investors that there's a concern there. That means money tends to rush to bonds. And then by that, the yield on bonds goes down. And then what that means is our 30-year mortgage rates tend to come down as well. And it spikes housing sales and home price appreciation. So anyways, there's a lot of ways to win in this asset class. I think we're going to see that play out here, especially as we enter confusing economic times and, potentially tough economic times for our country.
Yeah, that's man, I like that, right? Like I like this idea of like, hey, in good times, this is a good asset class. In confusing times, this is a this is a good asset class, right? Like the risk mitigation of if inflation happens, you have, like your assets go up, it becomes harder to acquire them, but your assets keep up with it. If unemployment happens, then interest rates go down, so it becomes easier to acquire these assets and continue to build a portfolio. As long as you are on the positive side of cash flow, you can rest easy because with a good operator, you stay in the market. History repeats itself. There is you get the answers to the test before they happen. Let me ask you something just on an anecdotal level, GC. We just talked about inflation, and that's one of the big factors. Unemployment is the other factor. You are a pretty big employer in Jacksonville, Florida, right? Like you guys employ 120 people. You're a business owner. You understand kind of like the levers of debt when it comes to running your business, and you understand that the Fed just dropped their rates. You're seeing the talent that's out there. A lot of fear around this like AI taking jobs and stuff like that. What is your kind of like ear to the grind. What is it? Ear to the grindstone? I forgot how that expression
I
goes.
think you put your nose to the grindstone, right?
No, is it nose to the grindstone? What is the ear?
Ear to
What
ear to the street.
ear to the street? Is it like, don't you put like your ear on like on the subway rails or something? I don't know. I don't know how it goes. What is your sentiment on kind of like um employment right now happening in Jacksonville?
I think, I mean, you're hearing a lot of, um, I hear a lot of anecdotal stories from friends who are super talented that are having a tough time finding jobs. I hear a lot of employers that are letting go folks. You hear a lot of big name employers, especially in the real estate industry, especially in the home building industry, that are unfortunately laying off a lot of people. So, I do think that this is a potentially a tough economic time as a country, and take the lens of the country, and being a citizen of the country rather than, how to benefit as a real estate investor. I think this is a good time for us to invest in assets that provide stability. This is a time to probably not go for grand slams and home runs, in my opinion. This is a time for singles and doubles with strong management in place from an investment standpoint. And I think you're going to see businesses question every dollar. I think they're going to question every hire. I don't necessarily think that's a bad move right now because we don't know what the economy is going to bring. This is probably the hardest time to kind of put a prediction out there as far as what the economy is going to look like 3 months from now and 6 months from now, because we are dealing with economic signals that in the past kind of led us to a conclusion, or at least a really good educated guess as far as things with land. And we just don't have the benefit of looking at historical information when we're assessing what the economy is doing right now. When you look at what the impact of potential tariffs could be, as well as what is going on with the labor market. And so it's, what I would say, if for everybody here, for businesses, for consumers, question your expenses, build up your cash reserves. I think this is a prudent time to do that, and think of the places you're going to put your money and make sure that those are your singles, your doubles with strong management in place.
Yeah. Yeah, it makes sense, man. It's kind of like in uncertain times, you either kind of like stay pat or you need to have a plan for uncertain times, right? So, as you've just kind of explained, if we're going to continue to save towards retirement and we're going to continue to, right, like the necessity is to continue to invest and continue to grow your nest egg, doesn't feel like keeping if your cash on the sidelines is, kind of like equally at risk with these uncertain times with inflation and stuff like that. You want to have some of it, but if you're going to continue to investing in something that is made for uncertain times is kind of the move. And you've made a pretty compelling, case for the idea
100%.
that rental properties is that, right?
Yeah. And, I think as humans, the easy thing to do is to just kind of put our head in the sand and kind of give up and put our dollars under our mattress or whatnot, or just keep it in the bank earning next to nothing. Guys, that takes you farther away from your economic and from your passive income goals, from your financial outcome that you want. It's not a good solution. You got to put a little bit of work in. You got to understand a little bit about what's going on. If we spent 10% as much time as we spend thinking about our active jobs and our active incomes, if we just spent 10% of what we spend thinking about that on our passive income and our future financial outcomes, we would quickly be able to accomplish those, and you would see the growth happen. And as a country, we'd be in a lot better financial footing. So just putting our heads in the sand and I know it's tough to understand some of these things, but just putting your head in the sand is not a solution. It sets you back. Tuning into calls like this, talking with my team, who is an expert in rental property investing, or choosing other assets that maybe pay you 5 ways and maybe are risk mitigated and provide some of these really important things during tough economic times. That's what we need to be investing, and that's what our community does such a great job of as not your average investors. Average investors are going to be hurting here.
Yeah, makes a lot of sense. If you want to talk to the team, you can go to chatwithjwb.com. You can also call them at 904-677-6777. or shoot him a text right now, 904-293-0341. GC, I kind of want to end with something the patron Santorius, Michael Santorius, just put it here in the chat. I want to do a little thought exercise for you. He's saying Berkshire Hathaway was holding record high cash pile of around 344 to 350 billion. So, you know, your boy Warren Buffett is right now sitting on a whole bunch of cash. I remember somewhere around like the 2010s, 2011, there's a clip that still gets circulated of Warren Buffett saying, you know, if I was to be putting my money somewhere, it would be in cash flowing rental properties, kind of like what you did a lot of back in that time. What would you say to Warren Buffett? Like, do you think like do you think he should be sitting on all that cash? Would you be putting that money in rental properties? Like, what do you think of their moves of like having this much cash on hand?
You know, I think Warren Buffett plays at a completely different level than any of us. And so, and he also aims to serve a completely different client than I aim to serve. You know, we're motivated by serving everyday folks and helping people accomplish their individual financial outcome. You know, he's controlling, hundreds of billions of dollars. And, you know, so to answer your question directly, do I think that Warren Buffett is probably doing a good thing based on his business and who he is aiming to serve to stack up 350 billion? I know very little. I know he wouldn't value my opinion very much, but to me, it sounds like a smart move for him because his investment alternatives are not my investment alternatives. I wouldn't have a place to put $350 billion. You know, he probably does. But what he also doesn't have is control. His investments don't offer the same type of control that everyday investors have access to. So I think his decision to do that is a reflection of kind of what I was saying, that we don't know what the economic times are going to be. And I think that in tough economic times, it makes sense to build up cash reserves. And, you know, his choices about where he puts his money do not have, a lot of times they don't pay five ways. A lot of times you don't have direct control as an individual investor. So yeah, so it makes sense to me from his perspective. Now, from my perspective, I think, yes, you should be building up your cash reserves. But once you build up your cash reserves as an individual investor, and direct ownership of rental properties is one of the best ways to not just build your financial future, but have control over it. It's not a fund. It's not a syndication, right? You have control. So I think once you build up your cash reserves, knowing we're going into economic times and knowing you need to put your money somewhere, look into assets that are hard assets that produce positive cash flow. Right. The easiest way to sleep at night is to have your money producing money for you on a monthly basis, not you just putting your money into something and hoping that there's a huge home run, 5 years later or whatnot. And Warren Buffett just doesn't realistically have the same options, as we have as individuals. So I would say for us, focus on cash reserves, make sure you understand where your money should be parked in tough economic times. That will likely lead you to a conversation of rental property investing. And when you do that, know that you're investing in an asset that is there to produce in tough economic times. It has served our clients quite well, even going back to the Great Recession. So I think single family rental properties will be a great time, or will be a great asset at a great time for us to have our clients build their portfolios. The economy, I don't know what the economy is going to do, but I know rental properties will be a good investment.
Yeah, as the economy continues its uncertainty in this very uncertain world I feel like we're all living in. Speaking of cash reserves, next month we have, not next month, next week, we're going to be joined by Tanisha Sousa. She is the founder of Tardis, and they're going to be talking about how to grow your cash reserves, how to increase cash flow through creative financial engineering strategies. We had a joint seminar, a joint kind of webinar with them a couple months back. A few members of our community have joined their program. They've really, really liked it. I know that members of the JWB team have joined the program and really, really liked it. This is not what we did last time. This is more them explaining how you can kind of do this yourself how you can grow your own, what they call like their income snowball, and also how you can hedge against risk, right? Like these like financial engineering moves, like the stuff that Drew Barnhill does and other folks in our community does, really makes sense when you know how to track it and you know how to like adjust for the risk. So we're going to dive into all that type of stuff, to get you a little behind the scenes perspective of how you would do it yourself next week on the show. Also, speaking of surrounding yourself with a community of folks, staying informed, the fairy godmother herself, whose birthday was earlier this week, outpouring of love in the community chat. I just want to wish her a happy birthday here on the show, but also she is hosting a meetup in Northern California, Saturday, November 15th. Plenty of time to sign up right now if you're interested in joining them in Northern California, around the Monterey Bay Area. Contact her and she'll let you know the details. Her email is jenniferfilzen@gmail.com and her cell number is 408-833-9868. So reach out to Jen, link up with the community in Northern California. It's a great group of people that gets together pretty regularly, and we love supporting that. GC, good job today, buddy. Straight from I think the Mountain Man asked if you were reporting from the back of a police car.
No, thankfully not this time. Maybe next show. Who knows? Tune in.
Maybe next show. No, so for those of us that joined late, Greg was just fresh off speaking locally here. Whenever we do the market forecast, all the local investor groups want to hear it directly from Greg. So he's out there spreading the good word of what the market is doing and explaining, with a little data and perspective. So today he had one that, forced him to report from his car, but don't let anybody tell you that GC will be stopped when it comes to showing up. He'll do whatever it takes to join the Not Your Average Investor show. Good job by you, bud. We had over 70 folks on today to listen to us today. We love having the community back. I feel like we had this dip during summer. Everybody gets busy, but now it's fall. Everybody is kind of like gearing up for the next quarter, wrapping their year up. We love having the community here. Great questions, great new folks joining us. We hope that you come back week after week, make a friend in the chat, and just keep making the best decisions for you and setting yourself up to succeed. And do you see any other pieces of advice before next week?
First of all, happy birthday, Jen, and don't be